The US Treasury just auctioned off 183 billion in government debt, and the Fed bought over 20 billion of their government bonds. Is QE back? What is demand for US Treasuries looking like? So we had an avalanche of bond supply over the past couple days. First one we're going to go through here is the 2-year. Remember, this trades primarily off of what the Fed is going to do with that overnight federal funds rate. We can see high yield 3.489. That is the lowest auction going all the way back to October 2022. Now, there was no tail, there was no stop through. It was known as on the screws, meaning the auction cleared at exactly the same price that the bond was trading at going into the auction. No tail, no stop through. Bid to cover, total number of bids divided by the total amount of bond supply, 2.68. This is the highest going all the way back to August. Now, the US Treasury sold $69 billion of these 2-year bonds. The Fed bought $7.9 billion. Now, taking a look at the internals here, we can see bid to cover is in red. High yield is in black. That is the price or the yield that the auction clears at. And then the various colored bars show the relative share of the $69 billion that each of these buying groups absorb. So direct bidders, firms bidding directly for their own book, primary dealer, buyer of last resort, and indirect, that is that foreign demand. So you can see the composition here. Primary dealers took down 11.1%. That is right in line with average. Direct took down 30.7%. That is right in line with average. And indirect took down 58%. That is slightly above the average of 57%. So relatively strong 2-year auction. The 2-year, the short end of the yield curve, has seen pretty good demand in recent past. So the next one we're going to go through here, 5-year auction. This one, a little bit of a different story. Tailed by 0.5 basis points. In fact, that is the 5th tail out of the last 6 auctions. So a tail, remember, means that the U.S. Treasury Department had to offer a discount on the bond's price. Put another way, a higher yield. So the tail is what the bond was trading at going into the auction relative to the yield that was required in order to get the auction to clear. Now, remember, with a bond, the yield is inverse to the price. So if you are offering a discount like the U.S. Treasury had to, in this case, that means a higher interest rate. In fact, 0.5 basis points higher than what the bond was trading at going into the auction. Bid to cover, 2.41. You can see already that is significantly lower than the bid to cover for the 2-year. We sold 70 billion of these 5-year notes. The Fed bought 8 billion of them. Primary dealers took down 11%. That is the 6 auction average there is 10%, so slightly higher than the 6 auction average. Never good sign when the buyer of last resort has to step in to take down a larger share. Direct bidders 27% and indirect 61.3. Again, the 6 auction average there 64.7. So the foreign demand, that indirect demand, was weaker than the 6 auction average. Here we can see the tail relative to the stop through. You can see that out of the past 6 auctions, the Treasury has had to offer a discount in terms of bond price. Put another way, a higher interest rate in order to entice enough buyers to come in to absorb the entire bond auction. So here we're looking at the bid to cover. Same concept with the buying groups in the various colored bars. You can see the bid to cover has ticked up ever so slightly, but has basically been flat for the past couple years. That is in black, and then green, red, and blue bars show the relative share that each buying group took down. Andy Constant gave this one a B+. By the way, he didn't give a rating for the 2-year auction. So moving on to the 7-year auction, we sold $44 billion of these 7-year notes, and surprise, surprise, we had to offer a discount on this one as well. So a tail of 0.6 basis points, that means a lower bond price, a discount on the bond's price. A higher interest rate was required in order to get the bond market to absorb the entire amount of bond supply. In this case, 44 billion. Bid to cover 2.46. The Fed bought 5 billion of this particular auction. Primary dealers took down 13.07%, direct bidders 20.2, and indirect, that foreign demand, 56%. So here you can see the past 4 auctions for the 7-year have tailed. So very similar to the 5-year, demand is not so strong with this particular maturity. Andy Constant gave it a B minus. So is the Fed buying bonds and engaged in quantitative easing? QE is QE back? No. So here in blue we can see the Fed balance sheet that has been declining. Now remember, the Fed constantly in their assets and their balance sheet constantly has securities that are maturing, whether that be a mortgage-backed security or a U.S. Treasury. There's constantly maturation happening with various bonds or securities. So if they are engaged in quantitative tightening and they're trying to tighten at, say, 100 billion per month, and they have 200 billion maturing, well, they have to reinvest 100 billion. Otherwise, their quantitative tightening would be too much. So that is just what is going on there with the Fed bids. I would point to the scarce liquidity regime. So we have a situation where bonds are scarce. There is more demand for collateral for US Treasuries than there is supply. The price is going up, and we'll take a look at that in a second. But you also have a situation where there's a supply demand mismatch when it comes to cash in the repo market. The $3.2 trillion repo market, we can see we are hitting the lowest level on this particular spread going all the way back to July of 2020. So yes, there is more demand for bonds than there is supply. That is why yields have come down. The bond price has gone up across the curve this past week or two. But you also have a situation where there is a supply demand mismatch when it comes to actual dollars, actual dollar liquidity. This is why we see repo rates starting to go above the Fed's upper bound. Here we can see we have been in a steepener going back to the end of October. However, recently over the past week or so, we have seen a bid into bonds, and this has been a bull steepener. That is typically what you see ahead of a Fed rate cutting cycle. Of course, we are in a rate cutting cycle. The 30-year yield has gone up since the Fed started to cut interest rates, which is demarked here with the red vertical line. We can see the 30-year yield was trading at 3.97 when the Fed started to cut. It is now higher than that. So that needs to be taken into account as well. So here we're looking at that tightening liquidity condition. Again, there's more demand for dollar liquidity than there is supply. So you have a very strange situation kind of developing where you have more demand for collateral, the US Treasury, the global collateral of choice for the modern financial system. Therefore, bond prices are coming up. Yields are coming down. Remember, they are inverse to each other. But you also have a situation where dollar liquidity, demand for dollar liquidity is in excess of the supply of dollar liquidity. And again, I would point people to the video I did earlier in the week that shows the SOFR starting to tick up above the Fed's upper bound. By the way, remember, liquidity strains don't have to be evenly distributed. Yes, 4.01 is above the Fed's upper bound for the median SOFR rate. But look at the 75th percentile. What this shows is that 25% of the 3.2 trillion financed in the repo market has already been above the Fed's upper bound for the vast majority of the past 2 weeks. So we're entering kind of a strange situation where you have supply demand mismatch with bonds, but you also have a supply demand mismatch, of course, with dollar liquidity itself. So anyways, hopefully that was helpful. A lot of debt auctioned off. No, they are not engaged in quantitative easing. This is just normal operations to manage the SOMA account and make sure that, of course, the average duration of their holdings is what they want it to be. They're constantly tweaking around to make sure that the average duration is in line with the outstanding debt. And they're also trying to make sure that as securities mature, they are not tightening too much. As we can see, of course, the Fed balance sheet is still in contraction. That ends here in just a couple days. So anyways, hopefully that was helpful, and I'll catch you in the next one.